Hello, successful and soon-to-be successful traders. Chris Capri here, secondskiesforex.com. This is a video that comes from a lesson that I had done in the Singapore and London seminars. And there were many lessons that we taught in there that they really kind of changed the way people thought about trading. Some of the traders had suspicions of it, but nobody had ever really said it before. Nobody had ever come out and kind of just talked about it. And so there was this one particular lesson that really kind of created a paradigm shift and a complete 180 in terms of how traders were approaching the markets. You will hear so many different ideas about trading, and it's not that some of them are or are not valid. Many of them are, but we have to understand the context in which they are valid and the context in which they share wisdom, and also in the context in which they share confusion. A particular method or piece of information can be in one context wisdom, in another context confusion. And so this particular lesson really kind of just hit a lot of traders, and they said, okay, now I get it. I understand what I need to be doing. And it kind of gives an insight as to one of the things that professionals don't really talk about. They haven't really elucidated. I haven't seen any lessons on it, but it's just something that is a staple across all of them. And that's the 90-10 rule of trading. And we're going to get into that. Before we do that, we need to kind of give a brief overview of the institutional world of FX, and not just FX trading, but also institutional trading as a whole. So when I consider the institutional world of trading, I'm basically kind of breaking it down into three general categories. So I wouldn't consider HFTs part of that, because without the technological advantages that they get through the shady, pretty much illegal relationships with their brokers or with the exchanges, HFTs wouldn't be what they are today. They would be very, very, very slim, almost non-existent. So I don't really consider them part of the institutional world, even though they are affecting a lot of order flow and movements on a daily basis. I really don't consider them part of that, and I think their time is limited. So when I am talking about the institutional world of trading, I'm talking about prop firms, I'm talking about bank traders, I'm talking about hedge funds. We could say multinational corporations, but they really aren't that active. I mean, there actually is some multinational corporations that are highly active. Like Porsche had actually, and I think it was 04, 05, they had made more money on currency trading than they had in their businesses selling cars. So, you do have moments like that, but by and large, they really aren't part of the institutional world. So institutional world could be mutual funds, pension funds, hedge funds. You're going to have your bank traders, and then you're going to have your prop firms. So that's generally what I consider to be the institutional trader world. Now, when we look at these individually, so let's just kind of go over them one by one. Prop firms mostly are day trading. They're incentivized by their broker relationships to produce massive amounts of volume. If you join any prop firm, you're probably going to be very active on a day trading basis. And a lot of their programs, their training programs, their kind of qualifying programs, you notice you'll have to be very, very active in the markets. And so they're mostly doing a lot of day trading. If they're doing any sort of swing, they're most likely going to be hedging those positions. And when I say swing, they're holding positions for days, weeks, months, maybe, several months at a time. And so when they're doing that, when they're holding positions overnight, they probably, or, for weeks or months, they probably have some sort of hedge to protect that position. Bank traders are doing a lot more swing and position trading with a lot of hedging involved. So most bank traders, people think that they're the ones who are kind of making all these trading decisions in and out each day. And really what they're doing is actually more flow trading. So flow trading is they have a relationship with a particular hedge fund who likes to execute their trades through that bank. They'll call up either the sales guy or the trader directly, and say, I need 300 million on the pound at such and such price. Can you give it to me? And they generally have about 1 to 3 seconds to answer that question. So that is flow. They're executing the flow of trades for their clients. And obviously, if they're able to give a lot of their clients flow and money, then they get a huge portion of their commissions based on that and their performance based on that. About 2 out of every 10 of their trades are going to be prop trades, and these are trades that they are actually taking positions in the market. And these, on a more often basis, are swing in position. You know, they can be anywhere from days to weeks. They can be months, maybe even half a year or a year. You know, they're trying to capture very large trends, and oftentimes they will add on to these positions as they move and progress in their favor. So that's generally what bank traders are doing, and there's often a lot of hedging going involved with them to neutralize risk as much as possible. Hedge funds, you do have some that are active on a more shorter term basis, but a large majority, because of the size and what they're actually doing, they're holding positions, you know, they're doing swing and long-term positions basically. And, you know, they're holding for weeks, months, maybe years. And they have many of these positions rotating throughout the year. So this is what, you know, a general, if you were to kind of take a snapshot of what institutional world is doing as a whole, and you were to kind of categorize them in different types of players, this is generally what it will look like. Now, some bank traders are going to be more, and some bank desks are going to be more active than others. Some are going to be, you know, taking 10, 20 positions a year. Some will take a few hundred. Some will take, you know, 500, maybe 1,000 different prop trading positions a year. Each bank has its own style. But this is kind of a general, I guess you can say, color to how they approach the markets. Now, when you look at the institutional world, it doesn't matter whether it's a prop firm, it doesn't matter whether it's a bank trade, it doesn't matter whether it's a hedge fund. When you look at them as a whole, you do see one commonality, and this comes into the 90-10 rule of trading, which is that they are generally in the market most of the time. And you have to ask yourself a couple things about that. You know, the most important question is, why are they in the market most of the time? Because you cannot make any money if you're not in the market. There's no performance fees to be made. There's no way you're going to attract clients if you're not in the market. If you don't have something rolling, they are going to be actively involved in the market most of the time. And this is where the 90-10 rule comes in, which is that generally across most institutional players, they're in the market anywhere between 75 and 95% of all the time. Now, that doesn't mean that they are constantly having to generate new trade ideas on a daily basis. No, that's not true. What they're often doing is they have oftentimes a lot of positions rolling that are going to take weeks, maybe months to mature. And so maybe they don't have an entire new trade for that week. This last week, heading into Easter of 2016, I didn't have any new trades that were activated, but I had 2 that were already open and were still rolling throughout the week and developing and progressing. You know, they had very large targets. You know, one of them has almost a 900 pip target on it, and the other one has about a 550 pip target. So those aren't moves that are going to, you know, just happen in a day or two. They're going to take time. Even if the market beelines it, if it hits my entry and beelines it for those things, you don't just move 550 pips in a couple days. That's going to take maybe a couple weeks. It may take a month. And so you'll notice, again, institutional players are generally in the market most of the time. And when you start to realize this, there actually is tremendous amount of advantages to this, and we're going to get into this. You know, and so I want you to start to think about, what are some of the advantages of being in the market? Again, that doesn't mean you have to try and find new trade ideas. Sometimes there really just aren't that many good trades out there. You know, I look at a lot of instruments, and, you know, last week or this week, you know, leading up to Easter, part of it I wasn't feeling that great. And part of it was I was like, I don't like this, or I just don't like the locations of prices right now. I think they're kind of in an in-between phase. So I could either not be in the market, or I could have some positions that are already running. Just because I didn't find any new trades doesn't mean I shouldn't be in the market. And so for me, I have a mix. I am a very active day trader, but for me to day trade, I need certain conditions in place. And some of those are, physical, psychological, and environmental. The market needs to look right. So when I'm day trading, I'm very active, but it's not that that's the only thing I'm doing. I'm also swing trading as well. Some of my positions take weeks, maybe a month or so to roll out. And so because of that, I may not have any new trades for that day, the next day, or the day after. I may not even have any new swing positions manifest or anything like that. But I'm still in the market. And I want you to think about, again, some of the benefits as to why that is. Now, it's important to understand that this is not something that you can just fabricate or manipulate or institute right off the bat. It's something that has to be scaled into, and it has to be built into. It has to become a part of your skill set. And we'll talk about some ways that you can do that. Actually, we'll get into this on the next slide. So for me, I do mostly day and swing trading. Numerically, because when I day trade, I can be very active on a day and do 3, 5, 10, 15 positions in a day. I could do that. I'm generally not rolling 15 swing positions at one time. But if I had to, classify my style, I am generally day and swing trading. I actually do have some position trades rolling. And so I actually have trades that are trades that can take 3, 6, 9 months, a year to fully manifest. And so, but the majority, the biggest bulk of my activity as a trader is day and swing trading. Now, day and swing trading both of them have their advantages and disadvantages. If you could only pick one between day swing and position trading, then I would either recommend you move towards day trading or you move towards swing trading. And you notice I'm saying one. And remember what I said in the last slide, which is that you have to build into this. So what this means is that you really have to get and dive into and go really deep with one of them. And it can be day trading, it could be swing trading. You really have to go deep into that before you start expanding into, another style or another completely different approach to the market. Because day trading, while technically there aren't really that much differences, there are mentally, psychologically, and cognitively. They're going to have a lot more differences in how your brain is functioning. If we were to hook up a headset to somebody's brain and we're analyzing different areas and regions and activity, if you were to look at a swing trader over a week versus, the neural activity of a swing trader over a week versus a day trader, they're going to be completely different. And that's because they're going to require, on a cognitive level, different skill sets. Now, the advantages, and I'll get into day trading and swing trading, so let's just start with day trading. The advantages of day trading are best illustrated by professional online poker. So I don't know if many of you know, I've been training with Poker Pro for a few months now. In fact, I've gotten to the point where I've now played about 40,000 hands. And, that seems like, wow, it's a lot of hands. But, on one online table, I'm doing about an average of 60 plus hands an hour. The thing is, I've worked my way up to now where I can play 4 tables at one time. So now I'm doing 240 to 300 plus hands an hour. So on a day off when the markets are closed for holiday or a weekend and I'm playing some poker, if you think about it, in one, 3-5 hour period, I can get anywhere from 900 up to 1,500, 2,000 hands. So it's not that hard to imagine how I got to 40,000 hands. If you look at online professional poker players, they're not playing one table. They're playing anywhere from 4, some of them can play up to 12 tables at one time, depending upon, their brain and their mindset. Why is that? Why are they playing multiple tables? Well, if you have an edge at a particular game, and you're playing one table, well, that same edge should naturally hold up, assuming you can train yourself to kind of think that quickly, the more tables you add. Eventually you hit a peak where it's too much. But if you were to watch a lot of professional online poker players, they're playing multiple tables at once because that edge, when multiplied, becomes greater. We'll get into this a little bit, we'll talk about this a little later during trade frequency. But the number of hands they play obviously is going to have an influence on how much money they can make. If I'm playing 60 hands an hour and I average, $200 an hour per table, well, then when I start multiplying tables, we can see how that adds up very quickly for the same amount of time. Instead of making 200 an hour, I could be making 800 an hour. And that's kind of what day trading is. By increasing the trade frequency, the number of trades you make, once we're able to build up an edge, the more we can multiply that edge via trade frequency, the greater our profitability is. So mathematically, day trading offers the most opportunities to make money. Poker players have realized this a long time ago. Some people in the trading world understand this completely, and you're like, yeah, that's totally true. And then some people who are trying to purport a particular narrative of like, no, you should swing trade, this is the only thing you should do. These people are pushing a very particular narrative that anything that opposes this really kind of threatens the validity of their ideas. I'm not married to day trading or swing trading. But the bottom line is the mathematics of it, just like poker players, completely play out. If you have an edge, when you increase trade frequency, you're increasing profitability. So day trading has its advantages. When we look at some of the other advantages, we have to talk about the feedback loop and cognitive load. So by having more trades, we're also increasing the feedback loop. The feedback loop is the information that you're getting from the markets about your ability to recognize patterns and make good trades. The more times you get feedback, eventually your brain assimilates that data to where, you kind of hit a certain threshold and it's kind of like, okay, I know this pattern works. I know this one doesn't. I know, by habit that I should be doing this. I know by habit I should be doing that. And it's not something that you know conceptually or intellectually. No, your brain just knows it because you've wired it in so many times. So because you're playing, just like with me in poker, once I started to increase, to 4 tables, the amount of times and instances that my brain was remembering what to do on this hand had increased by 4. From 1 table to 4, it increased 4 times, 400%. And so eventually I got to a place where it's like, okay, I know exactly I should not be playing this hand pre-flop in this position. It took me a while to memorize it. But if I had only been doing 60 hands an hour, it would have taken me a lot more times because my feedback loop was lower. So by increasing the feedback loop slowly and steadily over time, I eventually was able to assimilate enough data to where I can now, 95% of the time, know exactly which cards I should be playing pre-flop or post-flop in terms of what position. I don't even, there used to be a huge document I used to have up. Okay, don't play this one and do this and 3-bet here, 4-bet all in and do all this. I used to need a document like that. Now I don't. I just know. That is because the feedback loop had been increased, and so I learned it faster. The things you should know about day trading is that day trading requires higher CL, cognitive load. Cognitive load is kind of like this bandwidth of data that is being processed through your prefrontal cortex in your brain. And as you might, very much like the internet, based on your cable and subscription and plan and all that, you can only pipe so much data in there. Well, it's the same thing with your brain, that you can only pipe so much data before you max out your cognitive abilities to be able to accurately interpret and that information and act upon that information and execute. So there's not only a max in terms of the amount of data, but there's also a max in the amount of time. If you think about it, if you push the maximum boundary of that cognitive load, right off the bat, you only have so much time that you can withstand that particular max load. Whereas if you slow the load up a little bit, you reduce it, you can obviously withstand that tolerance for a longer period of time. Think of it kind of like gas in a car. If I had a racetrack all to myself and I had a car and I had a full tank of gas, if I floor that, that car, I put the pedal to the metal on that. Well, because I'm going top speed, I'm burning the gas at a much faster rate. So it won't take long for me to completely drain the gas tank. But that same gas tank, completely full, if I'm running it at a smooth 60 miles an hour versus 150, well, then obviously I'm going to get more miles per gallon. That same amount of gas can last longer. That's how cognitive load works. Day trading pushes the upper boundaries of cognitive load. It requires the highest amount of cognitive load of any type of trading out there. And so generally, the general formula is about 2 hours before you start to see cognitive performance declines. And basically means you need to take a break. If you're pushing things to your upper bandwidth of intensity, once you get about 2 hours, you're kind of done at that point. You need to take a break. And so, and part of that is neurological. You expire and use so many neurotransmitters, your brain needs time to rest and regenerate them. It needs the chemistry so that it can fire properly. So if you are a day trader, my general recommendation is no more than 1 to 2.5 hours straight. Take a break. 5, 10, 15 minutes is more than enough. Get up, go for a walk around the block, go have yourself a cup of tea, sit on the couch, play with your dog, cat, hang out with them, whatever. Talk to your wife. Yeah, do something to take a break. And it should be anywhere from 5 to 15 minutes at a minimum. If you have the space to take an hour off, fantastic. But you're going to need a break. Now, because of this, taxing cognitive load is just that, taxing. It's taxing on your brain and your nervous system over time. There's a reason why you generally do not find that many day traders past their 50s. It's a lot of cognitive load, and it tends to wear on them. There are some, but if you look at the majority of traders past their 50s, they're generally not day traders. And as they get older and older, that phases out even more. Very few of them are day trading in their 60s. So it's important to note that the lifespan of a day trader is going to be much lower in terms of longevity than a swinger position trader because of that cognitive load. The key and the most important thing, we'll talk about this in a little bit, is matching your natural skills with your style. What style should I do? Day trading, swing trading? How do I match that with my natural skills? And we'll talk about that. Now, if we look at swing trading is very different. It reduces cognitive load, but at the same time, it also reduces the feedback loop. So, there's a couple people out there who push this really ridiculous narrative that swing trading is the only way to trade. I only take 2-3 trades a month. And it's like, okay, well, to become a professional at anything, you're going to need hundreds, if not thousands of reps at it. I did an article about, trading like a sniper, what it really means. And if you look at snipers who are the elite shooters, they are able to use the least amount of bullets to hit their targets. The thing about it is they didn't get there by doing 2-3 shots a month, and that's it. Because they know that feedback loop, to hit a highly professional level, they have to get thousands and thousands of reps. It's called shots downfield. So, if you look at a sniper, they will generally do 1,500 to 2,000 rounds a month. And they will do that for months. And eventually they get so many repetitions, again, high feedback loop, that it allows them to be able to be so precise that they can do they can have the least amount of bullets to hit the most amount of their targets and do the most amount of damage. But you don't get there by trading 2, 3, 4 times a month. It will take you years. It might take your whole lifetime to build up a professional level of expertise. That's why these people who push the idea, just trade 2-3 times a month, you'll be fine. Nobody from their group has ever turned pro. Nobody will, because it's going to take them 50 plus years before they have enough reps to be even good enough to have a professional level expertise. And by that time, the market's changed so much, will they have adapted? I doubt it. Your goal should be, poker players know this too. You need to, and if you look at poker player profitability based upon the number of hands they have, it's a very clear trend. The more hands they play, the higher the probability that they will become more profitable. And this is pretty much the same with trading. That the more trades and rep experience, eventually you become more emotionally resilient. Psychologically, you're more disciplined. You let go of the bad habits. Increasing your feedback loop is important. Swing trading reduces that feedback loop. So you have to understand that if you're a swing trader, it's going to be a longer process to some degree. There are ways to accelerate that while being a swing trader, and we'll talk about that later. But just understand that. The good thing is it reduces cognitive load, so it's less taxing on your nervous system and your brain. It does take more time to wire in those subconscious skills, but the key thing about swing trading is it leverages time. It allows you to make money while you're sleeping. You can't do that while you're day trading. It allows you to make money while you're sleeping. I make a trade, I go to bed, I wake up, I'm up 150 pips. That's pretty cool. That's part of why trading FX or trading as a whole is such an interesting profession, because when I had a job a long time ago, and I'm so glad I don't have a job and don't work for a corporation or anything like that, as the saying goes, job stands for JOB, just over broke. And so, when I had a job, I wasn't making money for when I was sleeping. I was making money for the time that I was on the desk. That's one of the benefits of trading, is that I can make money while I'm sleeping. I can make money while I'm on vacation. I can make money while I'm in flight, while I'm traveling from one place to another. While I'm sick, my current positions keep making money. So swing trading leverages time in a way that day trading doesn't. And that's an advantage you have to be aware of. It does require more patience. And a lot of people think that, it's so much easier to swing trade. I just kind of set and forget, and I don't have to worry about them or anything like that. It's complete bullshit. Why? Because our brains naturally have a negativity bias. And you know what? You've tried that. You put on a trade, you went to bed. Before you went to bed, I'm pretty sure you were thinking, oh God, I wonder if maybe that wasn't the best decision. I don't know. I did see that. I did that. And then you wake up in the morning like, shoot, what happened to my trade? Did I make money? Did I lose money? I don't know. You're thinking about it. And I can't look at my charts right now because I'm at work and I can't connect to my platform. And what the hell's going on in my trade? The negativity bias is going to play itself out. You're going to think about your trade. Even the best of the best will still think about their trade. And so because of that, with swing trading, there are numerically and mathematically more opportunities for thoughts to be activated and for your negativity bias to be triggered. And so because of that, because of this longer period of time that you have to hold that position, it requires more patience. When I make a trade that... I remember there was when the hell was it? It's hard to get all the years right now, but there was a time period where I was only trading the 1, 3, and 5 minute charts. That's all I was trading. That's it. Those trades I could literally hit my profit target in a minute. Some of them maybe 5 minutes, 25 minutes. It's rare I was in a trade an hour. That doesn't require much patience, especially if I'm able to slow my mind down. I had trades where literally they triggered and they hit their target in the same candle. Sometimes within within 3 ticks, because I just happened to catch a high degree of momentum. And I was targeting 24 pips. So I was like, okay, well, I caught a high degree of momentum and bam, it moved, and 3 ticks later, bam, it's in my profit target. There's no patience required for that. I barely had enough time to fire out a few thoughts. And then it's just there. So the idea that, swing trading doesn't require as much patience and cognitive work, it's just not true. You have to understand that. The longer the time increases the patience requirement, the requirements of being patient with a trade. And it also increases the opportunity that the market's going to go profitable, negative, and oscillate. You know that trades, maybe 1, 2, 3 out of 10 trades, beeline it for your target or your stop. But the majority of your trades, the bulk of your trades, some of them start off profitable and then go negative and profitable, and they oscillate. Or some of them start off negative and then they turn profitable. Some of them do one flip and that's it. They start off negative, they go profitable, they hit your target. Some of them start off profitable, they go negative and hit your stop loss. That's one flip. But a lot of trades often flip a lot. Or maybe they go profitable and then they pull back a little bit. It's like, oh, wait, I'm only making half as much money as I was before. And what does that do to your mind and all the thoughts that it increases? So it's important to understand that there's no panacea, there's no free world where you're just, no matter what you trade, you're free from stress. It just doesn't work that way. It doesn't exist. Each one has advantages and disadvantages. It's important to understand the difference. So, how to determine the best route for you to move forward? As I said, you have to start with one. You have to really go narrow and deep with that. You have to learn that inside and out. And then and only then should you start expanding your repertoire and skill set. So, how do you know whether you should move towards swing trading or day trading? Well, there's generally a pretty good litmus test. Part of it, you're going to have to build some level of self-awareness about how you naturally think, about what you naturally lean towards, what you avoid, how what's your style of thinking. Because it gives you a very clear starting point to work with, a clear frame of reference. And there's two ways to really tell this. One, what is your general level of patience? Are you a pretty patient person? I've had many people order a course online from some country, that's overseas, and they're awake when I'm asleep. And they order, and within 1 minute, they're emailing me, how come I haven't gotten the welcome email? How come I can't get in the course? It's saying my thing's not activated. And pretty soon, within 5 minutes, I got 2, 3, 4 emails from them. And then the last email comes up, oh, I found the email in my junk folder. It's okay, thank you. That person isn't exactly displaying a certain level of patience. Everybody has a spectrum of patience that they can manage. Some people are more patient than others as a whole. Some people are less patient. If you are someone who tends to be very impatient, meaning you generally can't wait for seconds or minutes for something to kind of manifest before you know, or before you feel okay about it or not okay about it, well, you're probably someone who's leaning towards day trading just by your natural disposition. That doesn't mean I'm saying you should be impatient. No, that's a skill you're going to need to learn. It's a cognitive skill you're going to have to learn. But what it means is something, okay, you tend to be a more impatient person. You're probably leaning towards day trading. Also, what's the speed at which you think? Do you tend to really think really fast? And somebody says two numbers and within 0.5 seconds you got the answer. Multiply this times this. Oh, it's this. What about this? Oh, that. Or are you the kind of person let me think about that. You take your time with it. The speed at which you think tends to indicate some sort of natural disposition. Especially the speed at which you think in a calm state. If you're in a calm, relaxed state, but you still think very quickly, then again, that will lean towards somebody who's a day trader or has a more natural disposition to day trading. Are you someone who's okay with holding positions overnight? You're okay with things taking your time. You're okay with things, I can wait for that. No big deal. Well, then you're probably someone that leans a little bit more towards swing trading. There is no answer for this. There is no right or wrong in that. This is something that you're going to have to come to. But I'm pretty confident that if you really kind of sit upon and meditate on it, really reflect into it, you can kind of, with these two questions, you can kind of siphon out which is, one cap that you lean more naturally interested in the other. The bottom line is if your brain isn't wired right now to accept these drastic and unnatural changes, it's not going to without training. What do I mean by this? So what I'm referring to here is if I am a naturally quick thinker and generally pretty impatient, then trying on swing trading, even though it may conceptually or intellectually sound great, I can make money while I'm sleeping and I don't have to spend much time looking at the charts. Okay, that may all look fine and dandy, but if my natural wiring and dispositions right now psychologically are leaning towards day trading, developing into a swing trader is not going to be easy. For me to be able to increase from 1 to 4 tables, it was a progression, but it was something that was very natural to me because my brain can process a lot of information at the same time. I can be doing a lot of things at the same time. I can, be managing a lot of positions at the same time. I can analyze and calculate a lot of things at the same time. So it's very easy for me to do that. But for some people, it just wouldn't make sense. Don't choose a style because it may sound sexier or you think it's cooler or that may lead to more profitability. Just pick the one that's most natural to you. There's nothing unsexy about being unprofitable. And there is something really sexy about being profitable. It feels better. So hopefully this gives you a guide as to how you can start to integrate this 90-10 rule. Swing traders, by default, will have an easier time integrating the 90-10 rule because, as long as they have 1 or 2 positions rolling on a weekly basis, there's a good chance they're always going to be in the market, or at least in the market a fair amount of time. And so, their positions take longer. So maybe they don't find a trade for that week, but they already have one rolling. That's going to take 3 weeks to manifest. So in some sense, it's a little bit easier for the swing trader to build up into the 90-10 rule. For the day trader, it's a little harder. The good thing is that when they are trading, they're probably pretty active in the markets. But when they're, not trading, when they're asleep, they're probably not in the markets. So it's going to take that day trader a little bit of time to build into that. To oh shit, I have to wait 3 weeks for this trade to hit. Wow, that sucks. It takes 15 minutes. That's going to take time. And if your brain isn't wired to accept these changes right now and integrate them and relate to them, it's not going to unless you train that. So this is important to understand. Last key point, and I kind of want to wrap this up. So your goal should be stability. Whether it's day trading or swing trading, your goal should be stability. Stability represents a certain level of competence and skill. If I can, like in archery, this is how we trained. We started off at a certain distance and only until we could hit the target and maybe even hit the, the center on a relatively consistent basis would they increase the distance for us. By consistently being able to hit the center of the target, that distance, that represents a certain level of skill and competence. This is how you have to approach trading. So your goal should be stability and consistency, which will represent at least a base level of skill. Now, what does that mean? It means that over a 6-month period or a year, you made money. The thing about it is that, and this is the biggest misconfusion, so a lot of people think day traders are making money every day, every week, every month, every year. And that is just flat out not true at all. It's just not even the best hedge funds aren't even like this. Best hedge funds can lose 3, 6 months in a year and still be profitable. I myself win on average probably 6 months of the year. But because each trade I win is way larger than when I lose, that balances itself out. My winning months are very large and my losing months are not very big. Or they don't go that far in the negative. So why is 6 months represent stability? Well, Statistically, if we have 1,000 accounts that start the year, 77% will be profitable at the end of the year. That doesn't mean they made money every single month. Statistically, most professional traders will win about 2 quarters a year. That's 6 months. Now, when we look at it, for a trader to make back-to-back profitable quarters is not common. Of all the profitable traders, let's just say we had 100 profitable traders from a group of, what would be 7%? So let's say we had 1,400 traders. So 1,400 traders, 7% of them will be about 100 profitable traders at the end of the year. Of those 100 profitable traders, less than half will have had profitable back-to-back quarters. Less than 50. And then if you look at the ones from that group of 100 profitable traders, how many of them were able to string 3 profitable quarters together? It's about less than 10%. And in terms of the amount of traders of that group that are able to win every single month, you're talking like less than 3%. So of all the people who are making money, less than 5% are making money every single month. It's just very, very rare. 6 months, to be profitable at the end of 6 months means you had to have you had to at least won 1 month, but it's most likely you won 2 or 3 months. And so that means you probably lost 3 to 4 months. But over that 6 months period, if you're able to make money over 6 months while winning 2 or 3 and losing 3, that requires mental consistency. That requires discipline. That requires someone who controls risk. That requires proper mental execution. 6 months to a year, if you're profitable over a 6-month period, you've done a huge portion of the work. And if you're profitable at the end of a year and if you started out the year and beginning of the year and the end of your year profitable, you've gone beyond most of your conditioning, your negativity bias. You've overcome a lot of the emotional distractions. You've wired in really good habits. You've maintained consistent risk profiles. You're able to stick to your trading plan. There's no way you could do that over a year and not have overcome a good portion of your conditioning, not been able to manage your emotions, maintain consistent risk, and stick to your trading plan. There's just no way you could completely blow all those up and still be profitable at the end of the year. So once you have 6 months in place or a year, you have a stable baseline. You have stability. You have a base level of skill in place. Only then is it time to start integrating another approach, day or swing trading, whichever one you're not working with. And once you do that, then the goal of 90-10 becomes a very easy reality. Again, it already is easier for someone who is a swing trader, but there's going to be periods where you just don't find any good swing trades and you just don't have anything in the market. I've calculated the number of days this year that I didn't have any position in the market. So here we are. I'm recording this video on March 26th. I think we've had about 75 plus trading days, approximately. How many of those, and I'm not including Sundays, I'm just Monday through Friday. How many of those days were I not in the market? 4. 4 days. And let me tell you, it felt weird as shit. Because I'm used to being in the market. I've been used to being in the market for years now. I figured this out a long time ago. It just made sense for me to be in the market. I'm not making any money if I'm not in the market. That doesn't mean we seek to be in the market to make money. That's chasing after the wrong thing. But your goal should be to build into the 90-10 rule of trading, of being in the market about 90% of the time. Even if it's an option position, a put or a call or something like that. You're in the market, you're getting feedback, you have a chance to make money. You ain't paid for not trading. There, everybody talks about the benefits, like, oh, there are times to not, trade and things like that. It's true. There are times to not trade, not make new trades. And maybe there are times, extreme cases, where you shouldn't be in the market at all. But once you really start to adapt to the market and learn, when those times are, they aren't that often. Sure, there are going to be plenty of days where it's probably not the best idea to be initiating new trades that day. But it's very easy to get complacent in that and like, oh yeah, I'm not trading. I'm so smart. I'm staying out of the market when the market looks really bad. I'm so intelligent. Yeah, good luck paying your effing bills with that shit. I apologize for swearing, but good luck with that. Good luck having a profitable year spending a lot of time sitting out of the market. You look at the hedge funds, mutual funds, pension funds, bank traders, they're in the market most of the time. It's something that all institutional traders pretty much know. It's pretty rare that they are flat. It's very, very rare. And there's a reason for that. There's many reasons for that. So your goal is to build into this 90-10 rule of trading. It's a long lesson, 45 minutes. I apologize for going so long, but there's a lot of stuff to talk about here. I'm sure this is going to give a huge paradigm shift in terms of how you think and trade and approach the markets. And I'm sure there's going to be a ton of questions about this and a lot of thought-provoking and, new ideas and things about it. It's going to really, for those of you who haven't gotten this lesson that weren't in London or Singapore, it's going to really change the way you think about trading, the markets, your approach. It's going to shift the ground that you've been standing on. So, as usual, I hope you enjoyed this lesson. I really hope it kind of hit something home and kind of shook something loose in you and created all new ideas and got your mind working and things like that. So I look forward to your comments. I look forward to your questions, and I will see you inside the course.